little bit later. Thank you. Okay. Ladies and gentlemen, thank you for your attention. I think we had a truly historic day yesterday with President Putin and the Prime Minister of India making a really historic agreement. And I think that was a very salutary reminder of the global context and the global significance of the diamond industry and the importance of geopolitics in providing impetus to specific global industries. Potentially millions of people in two countries, two very important world economies, Russia and India, stand to benefit from this agreement. Prime Minister Modi described Russia as a key strategic partner and a friend of India. And this, some say, will signal a new world order and even with it a new diamond order. Perhaps this is a pivot for change throughout the industry. Certainly it raises key questions about how the industry's future now looks. Where will diamonds be in 10 years' time? Will the industry have succeeded in providing the unity to get to the places that are necessary for it to take a greater share of the luxury market? And can the miners, the big players, the big commercial players like Rio Tinto, like De Beers, actually develop the brand awareness that they say is so important for the future of the industry, develop the brand relationships? And will the luxury retail end actually satisfy the demands of the fast-growing consumer societies in burgeoning economies like India and China? So I think we have a very international setting for our discussions. India is right at the center of that, but there are other markets, not just China. Think about Brazil, in Latin America, and other future emerging markets. That's the beauty of the diamond industry. It is truly global. Now, we have immense support for our discussions over these 2 days from the government of India, and I think we've all been very grateful to our Indian hosts for the remarkable hospitality that has been shown to us already. And I think it would be really good to show our appreciation in the usual way for the Indian government and for the GJEPC. So, ladies and gentlemen, please join me. Now, I'm delighted to say that we have the Indian Commerce Secretary who is going to address us about the importance of the diamond industry to India. So, Mr. Rajiv Kerr, I would like to invite you to step up to address the World Diamond Conference. Thank you.
Well, good morning, ladies and gentlemen, Excellencies, distinguished delegates, ladies and gentlemen. First of all, let me thank GJEPC for offering this opportunity of talking to you on something which is extremely relevant and important for India, as the gems and jewelry sector is a very prominent player in India's foreign trade basket. I won't just call it export basket because it has an equal share in the imports. Diamonds, as part of the gems and jewelry sector, has a different role to play, and I'm sure you've been hearing this since yesterday. We had the pleasure and privilege of seeing two great leaders in the afternoon yesterday. In their inaugural plenary, they laid out the kind of setting that exists and the kind of setting that lays out for future for the diamond sector. And therefore, we see that diamonds over the next several years are going to play a significant part, of course, by themselves and by in the overall context of the gem and jewelry sector in India's foreign trade and consequently in its global trade profile. This is the first time that a global conference of this nature has been organized, and it is indeed a pleasure and privilege to see so many people coming from all walks of all parts of the world relevant for the diamond sector to make it to Delhi and to exchange their views on subject which otherwise has remained relatively undiscussed in a global setting. And therefore this organization of this conference in our perspective appears to be an extremely desirable and useful purpose. Having said that, since the topic I am supposed to speak is on India's the role that diamonds play in the Indian overall Indian foreign trade profile, I don't think it requires the knowledge of space science to understand. In a basket, in an export basket of 314 billion US dollars, diamonds, or let me say the gems and jewelry sector, composes about 15% of our exports. It is second in the overall scale. The first one, of course, is the petroleum and petroleum products, and that takes away about 37%. So between gems and jewelry and petroleum products, we take about almost 50% of our export basket. It's 46 or so. Clearly, we are talking of two crucial sectors. Petroleum, because we have huge refining capacities and because we act like an entrepot for petroleum products for regions in the vicinity and Africa, and therefore, for obvious reasons, we are the major importer of petroleum and the crude petroleum, and then the refining capacities created here contribute in a significant manner. So there you can see that there is a clear rationale which is built into India's need for imports and large capacities for refining existing, and therefore there is a natural position that petroleum products have in our overall foreign trade profile. But gems and jewelry, and particularly diamonds, are essentially a manifestation of the fact that India is home to the largest population of diamond craftsmen, artisans. And clearly this is an art, this is something which has got concentrated in India, and specifically in some regions. And I think that is what, over time, has evolved into India's major strength, the skill evolution, the skill accumulation, and the skills relating to not just crafting, but also to marketing. The entrepreneurial drive which has driven the Indian gems and jewelry, particularly the diamond sector. So clearly diamond and gems and jewelry sector as such occupies an extremely important place in India's export and import profile. Having said that, I think another significant aspect that one needs to keep in mind is the huge social connect, the huge socio-economic connect which diamond has with Indian economies. 3.5 million people are said to be dependent on livelihoods that they derive out of the gem and jewelry sector. Particularly, we understand that the diamond subsector supports about 1 million odd people in different walks of diamond trade, diamond trading, diamond craftsmanship, and so on. So it is not simply a sector which offers huge contribution to the Indian export and import basket, but it is also a much more important contributor to India's employment profile, and I think that is where the development policy impetus to diamond comes in from. Despite the fact that in terms of value addition, and I am moving from diamond to gems and jewelry, so please pardon me that, but clearly when you talk of the larger gold jewelry and sector, and then you compare it with the diamond sector as such, the value addition profile changes. You can have gold jewelry which may not invite a larger value add in it, but diamond cutting and polishing does involve a reasonable amount of value addition in terms of the craftsmanship which goes into it, but in the context of the high value of the product, the percentage goes down. But I think the bigger challenge for India now is to graduate to the next level of value addition, and that is convert this capacity to polish and cut diamonds to studding diamonds into jewelry. And I think that is where the real challenge now is. In the evolving paradigm of seeking greater value addition for all products that go out of this country, I think the more important thing is to locate various aspects, various opportunities where the value addition opportunities would make themselves available. And one of the most important areas, of course, is jewelry making using diamonds cut and polished here. And I think the follow-up to that naturally is the whole process of marketing. And marketing, and when I say marketing, I am talking of branding, I am talking of raising the level of just being a supplier of cut and polished diamond to reaching a point of retailing, which is an extraordinarily complex and again specialized skill-oriented job, particularly in this sector. So I think the diamond sector, amongst many challenges, the diamond sector as well as the gems and jewelry sector, amongst the many challenges that it faces, the more important challenges would be to give that additional value add by way of graduating to jewelry making based on diamonds, and then to see how to create brands, which is an extremely expensive and skillful job. I think one aspect which throws a lot of challenge to us is making ourselves, while there is little competition as of today, but I think it is equally important to see where is the competition coming out from and what is the process in which this competition tends to evolve over the next several years. Now this is an area which I am sure the experts addressing the gems and jewelry sector would be cognizant of and would be addressing, but I think it is in the long run important to keep a track of the choice and trends which impact the diamond sector, because ultimately as we go along, I think what is more important is to drive the human preferences rather than just respond to the preferences which are coming out from other countries. And I think that is where the whole issue of branding and the whole issue of designing and adding greater value by way of modern means of representation, etc., comes in. I think these are areas where there is a need for us to build additional capacities. These are areas where the diamond sector needs to focus on, primarily to build skills and capacities. I think one of the major endowments that India offers is a young population which can act both as consumers, driving the demand, and which can also give us a significant population of skilled manpower, specifically trained for this purpose. That is perhaps one of the major endowments. I had the chance of seeing one of such institutions recently, only a couple of days ago in Jaipur, and I was very happy, very delighted to see the fact that everyone who gets out of that institution gets a job. And that is where the economic development impetus of the diamond sector or the gems and jewelry sector comes in. Because if you link the growth of a sector with the overall economic development objective of the country, there is a natural connect and there is a natural drive for growth of that sector. And I think that is what we need to capture, that is what we need to work on. It was in this context that yesterday you heard the Honorable Prime Minister mention about the possibility, the decision to create a special notified zone for diamond trading, for rough diamond trading. And I think that is one of the major steps that will help in making India's product, which comes out of India, more competitive, and because you will be in a position to save that extra amount that goes out by way of commissions, by way of transaction costs, and so on. So I think this is where we need to play a bigger role in both in terms of trying to cut costs and also trying to see how newer elements of production, technology, production, marketing, branding, designing are on a very regular, in a very regular manner are introduced in the sector. So these are the major challenges. Now, clearly, wherever a country has offered itself as a country contributing the skills for manufacturing, it is invariably seen that the driving of that sector is not left to that country. The driving of that sector is left to those who market that product. And this is true for any product area, because ultimately the greater value is screamed off in the marketing part of that exercise and not the production part of that exercise. That's true for leather, that's true for textiles, the upper reaches of garments, and so on. I think this is where the Indian industry's biggest challenge is, because that is where if you want to derive that extra penny out of this whole process of India's gems and jewelry and diamond trading is concerned, then you have to see how to position the sector on some of those 4 or 5 parameters that I mentioned earlier, because that is where you will save that penny to add to your income, and that is where the newer skills, the newer capacities, the better utilization of the new demography, etc. will come in. So today, the Department of Commerce proposes to basically focus on this aspect of, again I want to interchangeably use gems and jewelry sector and diamond as such, because the usual run-of-the-mill modicum of operating of a sector gives you an advantage only to a point, and thereafter your competitiveness comes out of how you skillfully manipulate the various production and marketing processes of that sector. And I think that is the biggest challenge that you have. So we propose to work together with the gems and jewelry industry. We propose to work together with all stakeholders within the country and outside, and try and see how we can continue to derive greater value than what we are deriving out of this sector for the benefit of the country, and how we can create more employment opportunities for the country over the next few years. That is all about that I would have liked to say. Thank you so much. I'm sure you have had a good time and had fruitful discussions. Thank you so much.
Please don't leave. I'd now like to thank Mr. Rajiv Kerr very much for that very inspirational approach that the government of India is taking to support not only the diamond industry but the wider gem and jewelry industry. And that means good news, not just for diamantaires and the diamond trade in India, but outside as well. I'd now like to call on Mr. Vipul Shah, the chairman of the GJEPC, and Mr. Alex Popov, the chairman of the WMDF, to present a token of appreciation to Mr. Kerr and to the government of India, indeed.
Sorry.
Please be careful. Thank you. Thank you. So, after those very perceptive remarks about what needs to be done by governments to support industry, and in particular I'd like to just emphasize for a moment the Commerce Secretary's remarks about the importance of branding, about marketing, about the use of technology, not just for the diamond industry, but indeed for all industries in the Indian economy. Quite clearly, there's a very proactive drive from the government of India. And we'll have an opportunity to talk a little bit more about that in our retail session. And in particular, the different types of approaches taken by different retailers right at the end of the diamond pipeline. So the interface with the consumers, the end product of all your efforts in the industry. But before that, we're going to focus on a very important aspect of the diamond trade, which is financing. Financing the diamond trade in difficult, challenging times. The challenges come not just from the industry itself, but from the wider international context. And of course, we all know that the global banking crisis, the problems with the financial sector, have impacted on the diamond industry like all other global industries. And to chair this session, I'm going to call on Haim Evans-Zohar, who will masterfully steer you through the complexities of financing of the diamond industry. Thank you.
Where is the pointer? The pointer. The pointer. No, the pointer. This pointer, this way. Good morning, friends. You know, when you're an analyst or a journalist, you make headlines. When you come back from a conference, you ask yourself, what's the message? And yesterday morning, we started out talking about how this is historical and how this is special, etc. And I have changed the message. After hearing the Honorable Commerce Secretary and getting the message from your Prime Minister, Mr. Modi, my taking away is that in 2015, the Indian diamond jewelry sector is starting its golden age. I think that is the message, and it is the truth. And it is, you work for it very hard. Now, Mr. Secretary, you mentioned about the integration with jewelry. Your biggest market is the United States. You can wake me at 3 o'clock in the morning and I'll give you all the statistics. And when you have the United States polished, they import about 18 billion. And most of it is all exported again. Domestically, the market, the diamond market, is about 8 billion in America. But if I look at the statistics, it's only 2 billion of loose diamonds. Sir, already in America has close to 70, if not more, % of the diamond imports is already set in jewelry. And it comes from India and China. Not only that, it comes from Indians in China. I mean, it is, so we're getting there. And it's amazing. And with your government, with your Prime Minister, and with your stewardship, this is the golden age. Now let's see if the banks will make it also happen. Because we all want growth. You got, can I have the slides? How do I get my slides? Oh, I do that myself. How do I get the presentation? It's there, it's not here. I have a beautiful presentation if you just come up here and have a look here. Woohoo! How do we do that? We lost it? Forget it, go have your retail panel. I'm serious. How many people can stand up there?
This presentation. Can you put the presentation up there? Yeah, this one.
She knows. It's up there. It's up there.
Yeah, so he has to change the feed. Yeah, the presentation is already here. Can you put the feed here, please?
I'm known in this industry of being a great believer in conspiracies. Anyone that knows me knows that. Yeah, back, good. And this works? We heard, I want to make a footnote on yesterday. We heard yesterday all the projections about demand and about the future. And all those nice big lines going upward. And most of them are based on GDP and GDP plus. And there's one slide. Can you go to the next slide, please? Lovely. There's one slide I would like you to see. This also doesn't work, but we'll get used to that. The red line is the GDP. And I'm taking it from 1999, from 2000. See what is the GDP growth on the red line. See the diamond jewelry retail sales on the green line. Ladies and gentlemen, the gap between GDP growth and diamond jewelry growth is enormous. And just to assume, first of all, it shows how important branding is going to be, and that we have to get the act together and we have to do something about it. But you can actually see that the diamond content in retail, which is the black line, is higher than the green line of the diamond jewelry retail. That means we are still very prominent in the retail, and even getting more prominent in the retail. Look at the inflation, which is much lower than the GDP. But we have a problem. And I don't want you want to walk out of here thinking if GDP goes up, demand will go up for diamonds, because there's nobody that can show me that that is actually happening. And I just wanted to correct, to make that footnote on yesterday. We have work to do. Next slide, please.
Let me help you.
We have seen this yesterday. And also for the benefit of the Commerce Secretary, I want to put it once more. We are the middle sector, the diamond sector. And this is what goes in and this is what goes out. But now we're talking about banking. Have a look. Our annual rough purchases are about, in 2013, you see about 15.5. But the bank borrowing is about the same. Of course, it's not all the financing for rough. It is the most of the financing. 65% of the financing goes to accounts receivables, but rough is being, old cycle is being financed. You know, the Hof suppliers, Mr. Secretary, the Hof suppliers are the only people in this business that don't give credit. Everybody else has to give credit, not they. The interesting part, the Bain report, and I recommend it to you, that was published last week, or actually this week, has a fantastic section on financing. The Bain report says something very nice. In the short term, they say, and even midterm, this industry may need to be financed from the downstream and from the upstream. I never thought I would promote the Bain report, but I would hope that the producers will see it. Because that is one of the reasons that we have so many problems the Bain report also points out exactly how much profits the miners are making, but let's not do that in this section. We see here that the bank borrowing at the moment is around, we put it on 14.8, I would say it's about $14.5 billion, and there's about another billion in securitizations outstanding in addition to it. Where we see the... Okay, so you do it. It's working. Good, so give it back to me.
Sorry.
You're really cute. Okay.
Okay, I'll operate it from here also now.
You know, I just want to put up the price movements of rough and polished only because of the financing aspect. At the moment, and that's really the bad news, so inventories are growing. Inventories have become enormous. And we think if we talk about the $15 billion rough that gets in and the $22 billion gets out, we think that in the polished inventories are around 8 billion, correct, Pranay? 8 billion, and that is a lot. And we see also that expectations are of softening prices. And that means that people are offloading at a loss to avoid a greater loss later. We have to change the perception, we have to change our attitude, we have to change the market. In a rising market, things are much better. But in a market that goes down, of course, banks are more cautious than before.
This is working.
You are magical. You have a few more? But what is it's so important, and I think that this is time that we say this publicly, because those are things we all know, but we never talk about. The industry growth has been fueled almost entirely by bank borrowing. If there is more liquidity, if there's more working capital, we see that there is more goods, there's more purchases. It's a one-to-one, and it's amazing. And that shows the importance. We will not grow without having the money. And we will not have the money if we don't have the margins. I mean, it's just a vicious cycle that goes on and on. But let's face it and let's not do as if it is not the case. We need the money. Now, you are lucky in India that you have state banks. You are very lucky in India because the government you're having. And I show you later on a slide that shows that worldwide in India you have over 40 banks financing the industry versus about 5 in the rest of the world. And where it's increasing is in India, and where it's decreasing is in the rest of the world. All in line with what is logic if you go into a golden age. Here you see the same thing we said before. Yesterday we showed the value addition, and that is the black line. Is really not going up. It is all the time hovering around the 4 and the 6, 7 billion. Don't look at those peaks that you have in the crisis, because then you have a different situation. There's no. But the value addition of this industry remains fairly constant. But look, stocks, and stocks means really accounts receivables and your inventory. Stocks and bank debt go up in tandem. But in the last year, we see that the stocks and receivables are going like this, and the bank debt goes like this. That is not good. Had the bank that should have gone lower. And there are all kinds of reasons for this. Again, this is our analysis, and I hope that bankers, if bankers can show me that I'm wrong on this, that's the first slide I would love to repair. But that is the situation. But again, it is a one-and-one. This came from the Bain & Company report, and since the Bain & Company report is also very much based on our research, our meaning TC Limited, I took the liberty to put this up. If we look at the total pipeline, we see that the producers are financed from corporate financing, equity financing, etc. Retailers very much so as well. But the diamond industry is almost 100% depending on diamond financing. We have not been able to generate other financing. Yes, I said already before, there is $1 billion outstanding in securitizations and other things, but basically it is diamond financing, and I personally don't think that we'll see a major change in that in the years ahead. We have to be nice to our bankers, but our bankers have to be nice to us as well. I very much believe it's a two-way street. The last introductory remark about the situation of the financing, we can see here how we have 60 banks in India. This is what Bain says. I said 40, but let's settle on 50 in the middle. There are a lot of small banks. We don't really know. And then you have 4 major banks and a few others, really. Now, if the Antwerp Diamond Bank is out, we don't want to talk about that today. They were supposed to be in the early draft of this program. They appeared when they didn't appear. Their exit is a fact. But not only that, it's high speed they try to collect all the outstandings. And that is not fair to the industry. You cannot say within 2-3 months or 4 months just pay back. That doesn't work that way. And they were a considerable part of the industry, and for some of the pressures really comes from the withdrawal here. The withdrawal should have been, and I still hope it's not too late, more gradually. This is the situation here, and now I'm trying to call on the panel members to come up at the podium, because like yesterday, we had all the producers here, and we had about 90% or so of the world, so between 80 and 90 of the world production on the podium. Now we're going to have, I would say, most of all the diamond financing on the podium, and I would invite our friends from ABN AMRO, Standard Chartered, Howard, and others who are scheduled to be here to come up at the podium and convince you or help, give them a chance to convince to you that they are really out there because they want to help the industry. So if we give them a hand, Eric, then you guys will go up. Thank you. You're actually, you're the next speaker. You can take it from there, Eric.
Very good. Very good.
This is the one that works.
Well, I only have one slide.
You don't need this? You don't need this?
I know that by heart, so thank you.
I can put that slide for you. It's right here.
Yes. So we put up that slide, but I'm conscious of time, and the golden age just started, I heard, so that's a good thing. I hope you can hear me. No? Okay. Technology. Yes. That's the one. Are you okay?
Yeah.
Perfect. Well, talking about golden ages, this is 150 years ago for those who can calculate well. But dear Excellencies, dignitaries, clients, colleagues, ladies and gentlemen, and friends of the diamond and jewelry industry. It's with great pleasure and honor to stand here before you at this moment and to address an important topic which keeps all of us busy. Chaim said it clearly. It's the bankability of the diamond sector. I don't think the term bankability exists even. I don't think it's in the dictionaries, but I think the bankers made it up. But I think everybody knows what we mean with that. The honor is also with me because de facto, ABN AMRO had here its presence in India since 1920, and we started in Kolkata and Mumbai. The bank had 28 branches since, in 21 cities, offering a comprehensive range of financial products and services with more than 6,000 people. Talking about employment, of which about 25% women. Talking about diversity. But that's history, unfortunately. But a history we can be very proud of and can build upon again, if and when possible. I had to dig deep in history as well, to be able to put the current affairs of our industry on the financing side into perspective. And I ran into an advice to bankers dating from 1863 on the slide here. And that came from Mr. Hugh McCulloch. And you might wonder who's Mr. Hugh McCulloch. Well, he was at the time the controller of the currency and later Secretary of the Treasury in the United States. And his advice to all national banks in the US was reprinted in the Wall Street Journal on March 17, 1933. We all know what happened in those days, the Great Depression. But it's interesting to read some of the paragraphs. I'm not going to quote all of them, but some of the paragraphs Mr. McCulloch wrote in 1863, remember, 150 years ago. Let no loans be made that are not secured beyond a reasonable contingency. Do nothing to foster and encourage speculation. Give facilities only to legitimate and prudent transactions. Insist of payment on all paper at maturity. Distribute your loans rather than concentrate them in a few hands. Large loans to a single individual or firm, although sometimes proper and necessary, are generally judicious and frequently unsafe. Large borrowers are apt to control the bank, and when this is the relation between a bank and its customer, it's not difficult to decide which in the end will suffer. Remember, I'm still quoting from 1863. For every dollar that a bank loans above its capital, its managers are under strongest obligations to its creditors, as well as to its stockholders, to keep constantly control. Treat your customers liberally. I think it goes two ways. Treat your customers liberally, bearing in mind the fact that the bank prospers as its customers prosper, but never permit the customer to dictate your policy. If you have reason to distrust the integrity of a customer, close his accounts. Never deal with a rascal under the impression that you can prevent him from cheating you. This risk, in such cases, is greater than the profits. The capital, and I'm still quoting, and then I stop quoting, the capital of a bank should be a reality, not a fiction, and should be owned by those who have money to lend and not by borrowers. Pursue a straightforward, upright, legitimate banking business. Never be tempted by the prospect of large returns to do anything but what may be properly done under the law. Well, I stopped quoting, but so far the quotes. And I think we all recognize it. It sounds a bit harsh, but this is the reality we've been going through over the last few years. So the conclusion in the Wall Street Journal in 1933 was that these ideas of Mr. McCulloch were still applicable in those years, particularly those years before the Great Depression. But moreover, that these ideas were no less significant for bank borrowers than for bank officers. And that's where I think Chaim was referring to as well. We have this common responsibility. And I really believe this conclusion is still valid in 2014 and starting of the golden age going forward. So here we come to the key of my address to you. Apart from lessons to be learned from the past, we're in this together. Both banks, as industry players, have a shared responsibility to keep the finance levels to the industry attractive and at the right levels and conditions. But parties can and will have to make their own choices. It's a free world. So the formula to bankability is very simple. and I would really like you to remember that bankability for us is the sum of the profitability and transparency. Bankability is the sum of profitability plus transparency. Profitability speaks for itself. Bottom line versus just chasing top line results, improved asset conversion cycles, better efficiencies and innovation in manufacturing, and advanced purchase strategies are key examples. Destocking and reducing non-value added trading will be essential to the future. De-risk and de-leverage balance sheets. Please mind in this context, the end consumer market growth seems to be single digit, and we saw the figures earlier. That's a worry. And we know there's still excess inventory, recycled diamonds flow into the market rapidly. So the question for the producers is how to manage sales carefully to avoid excess output. Transparency, and remember bankability is the sum of profitability and transparency. Transparency means audible and complete set of accounts, consolidated reporting and clear corporate governance, including UBO identification at all levels, including ownership, independent stock valuations, development of price indices for rough diamonds, and ways to evidence compliance on business processes and applications. That's transparency. Think also of developing industry standards on business principles, of business processes, systems, valuations, consolidation and accounting. Standards next to the existing standards around KP, IFRS, the best practice principles, and the RJC code of practices, for instance. From the finance side, we need to look for development of structured solutions and syndications, more asset-backed, and I think it was also mentioned in the Bain report, more secured lending, including introduction of consortia, which model has been so successful here in India. That should include also investigation on how to spread the debt burden, and Chaim, you mentioned it as well, and you have not read my speech, I hope, but it's about spreading the debt burden of the mid-segment throughout the value chain, including producers and retailers. Why does the mid-segment of the industry feel it should be the financier for the retail industry? Is the product not special enough to request shorter or better payment terms from the retailers? Sorry, Mr. And of course, are goods delivered on memo still feasible and longer term? Are cash payments in advance for rough to the producers the only formula? Just questions we need to work on, and that could be a discussion also in the panel. Also, we believe that industry bodies like the respected World Federation of Diamond Bourses, the Responsible Jewelry Council, the Gem and Jewelry Export Promotion Council, and thank you for organizing on this, people, the International Diamond Manufacturing Association, the Antwerp World Diamond Center, DMCC, all the bodies, all the other industry bodies in the sector should be much more monitoring the behavior of its members against their standards and enforce compliance, evidence proof, and take appropriate measures against those damaging the reputation of the industry, and award, at the same time, and recognize those who set the right example. Same for the World Diamond Council and its quest to further develop and enhance the Kimberley process and their initiatives to support the overall industry in a sustainable manner. Our full support for this. Important to stress the need that the sector keeps on investing in KP and enhances and continues to develop the process. It's called a process, so it takes years and a process going forward. Also good to see there are also many initiatives on investing in brands and in marketing. It was a topic for this conference as well. That's why we look as bankers as well. Commitment, and commitment to the branding of the beautiful product. Commitment to a true and literally transparent and clean and trustworthy and reliable product for the consumer. That's where the future lies, in our opinion. That's where we expect business continuity. That's what we like as banks too. It's also about living the best practice principle, and other industry codes are mentioned, rather than just see them as a tick-the-box exercise. So live the principles, don't just tick the box. Take matters as corporate social responsibility very seriously, and we heard it earlier yesterday as well. It's all about sustainable industry, and sustainable, or in other words, earning the right to exist. That's my sincere call for action. The good thing is that we see an industry responding in trying to become more corporate, and just like any other industry sector going through change, the diamond industry is not different. Only the end product for the consumer is. We do see the innovation in technology, discovery, efficiency enhancement, and that is key to become like any other industry sector. If the profitability is at the right levels, if the transparency is there, bankability is there too. And I said it before, for good companies there is enough liquidity, and I keep on repeating that. Particularly if the risk-adjusted returns are at the right level in the sector, and when the overall reputation improves further. Other financiers like banks, but also investors, will be attracted to invest and allocate assets to the diamond and jewelry industry. We don't need more financing, but we need more liquidity providers. And fortunately, we see already some of them coming in being invited by us and other banks to come into the sector. Personally, I believe the sector can do easily with around 2 or 3 billion less external funding gradually. A slow kind of deflate of the finance bubble. Chaim showed the figures of the last 10 years or so. Also, outside of India, there are not many financiers active anymore, particularly because the industry, from a macro perspective, is not that large. Let's not forget that. We saw the figures too. But also, the industry has not polished itself sufficiently to make it attractive. And personally, I believe the challenge of the consumer interest in the end product is much larger than the challenge we have on the bankability. But I'm positive and pessimistic sometimes, I say. Like I was referring to the message from the US strategy in 1863, history always repeats itself. There we should learn from it. Like I said too, ABN AMRO was active for almost 100 years in India, and I'm sure we will be there for the next 100 years. India is undergoing a massive turnaround and new leadership, and we hope to be part of that turnaround. Just the mere evolution of the creation of a middle class in India will bring above average growth for the next 20 years or so. And I'm sure the diamond and jewelry industry will continue to both contribute and benefit of such a growth. So the future is yours. We love to stay part of it, and we thank our clients to make that all happen. Thank you.
I need to make a footnote here which is essential, because you're far away from Belgium, and some of the people may not be familiar. We have all seen that the ADB, the Antwerp Diamond Bank, left the industry. It had nothing to do with the industry. Diamond financing, and I'm the one that wrote the history book of the Antwerp Diamond Bank. They have been in the business for almost 80 years. They have made profits virtually every year. They went out because there was a deal made between the government and the bailout of KBC. KBC got money from the largest bank in Belgium. They got money to be bailed out in 2009, and then they committed themselves to having to dispose of assets, insurance assets, Eastern European assets, and the Antwerp Diamond Bank. So people did not want that bank to go. The Flemish government didn't want that bank to go. The industry, the bank itself didn't want to go. But it was just a political deal for KBC to be bailed out. It is not a reflection on what we call bankability. It is not that that bank had doubts about its clients. And I want all the, especially government people here, to walk away with that. It is not that we're having this situation of all of a few $1 billion gap because of any problem in our industry. And I hope that Eric will confirm what I just said, because it's very important to see that in perspective. You comment on that, Eric? This is the thing.
Thank you.
That's the magic finger.
I found the thing. Yes, thank you. That's absolutely correct what you're saying. And of course, being every week in Antwerp as well, I'm very close to the developments over there. We have good contact with ADB, of course, also with AWDC. So I think the most important thing that this wind down is going to be very gradual. And I don't think I should speak on behalf of Antwerp Diamond Bank, but from what I know, they are clear that they also have good discussions with their clients. They invited the clients to come up with their repayment plan, and it's not something over the next few months. That's something which will take years, and they're committed to that. And basically, from what I understood as well, is that ADB will be folded into KBC. So there's a process, proper process, and in order not to distort the market too much. But of course, it will take away a significant amount of financing in Antwerp, but it also creates opportunities for others to come in over there. So I think it's also a great proposition. I mean, never waste a good crisis, I would say.
Thanks for that, Eric. Howard, even as a moderator, there's always a super moderator. Howard is really the finance man at De Beers, and he knows more about financing and the clients than almost anyone else there. Howard, the floor is yours.
Good, thank you very much, Chaim, and Eric, do you have the magic finger?
Magic finger? No, it's there.
Yeah, it's this one?
Yeah, it's this one.
Good. Well, yeah, Eric, thank you for those words, and I think you and I share the same dictionary. Even if it's an unconventional word, I think my theme is going to be bankability as well. And I think we share a taste for history as well, because I'm going to be looking back into history a little bit. But, yeah, distinguished delegates, excellencies, ladies and gentlemen, Mr. Chairman, thank you for the opportunity and the honour to address the World Diamond Conference. And my name's Howard Davis. It's a real pleasure to have so many familiar and friendly faces in the audience, but for those of you who don't know me, I head up commercial development. And I joined De Beers 25 years ago as a rough diamond buyer. And I'd like to open my presentation by introducing you to one of the most important phrases I learnt when I first started to buy rough diamonds for De Beers back in the early 1990s. And that phrase is Mazalu Baracha. It's a Hebrew phrase. Not everyone in the room is a Hebrew speaker, so let me explain. It means good luck and a blessing. Now, I learnt that when I was buying diamonds, even worth hundreds of thousands of dollars, the only contract I needed was simply to look the seller in the eye and shake his hand and say the phrase Mazalu Baracha. And that simple phrase was more than a gentleman's agreement. It had the force of an unbreakable contract of trust. Trust was everything. And back then, that was simply how the diamond industry seemed to go about its business. No one seemed to write anything down. Everything seemed to run on the basis of Mazalu Baracha. And it's a convention that went all the way up to De Beers and its sales to the sightholders. It wasn't until 2003 that De Beers introduced its first written sightholder contract. And when I first started to have meetings with the diamond industry's bankers, also in the 1990s, it seemed to me that the spirit of Mazalu Baracha was also guiding this small group of specialist banks in how they funded the industry. Back then, what the banks seemed to value more than having a clear picture of their client's group structure, or their equity base, or their stock value, was simply the quality of their customer relationships. Just like the trade they were funding, in the end, it seemed the banks too were depending ultimately on trust. Well, that world seems like it belongs to a whole different century. And Bob Dylan summed it up well, as he so often does when he sang this song. The times they are a-changing. And times truly have changed for the banks. And Eric didn't really touch on in his presentation some of the issues that banks are now facing. AML compliance, CFT compliance, KYC compliance, risk weighting of assets, Basel II, Basel III compliance, and all the tough conversations that follow between a bank's diamond division and its risk committees and credit committees. This is simply how the world is these days, and it's a world away from the days of the 1990s. The trouble is, even if the times they are a-changing in the world of finance, some businesses in the diamond industry have been turning a deaf ear, and in a world where banks have no option but to demand ever more transparency from their customers and clearer corporate structures and ever deeper insights into their customers' financial performance, some diamond businesses still prefer to look back to the carefree days of Mazalu Baracha. Maybe this is because we all work with such a unique and a special product. Perhaps we feel that our businesses can also be unique and stand apart and somehow be different from the rest of the commercial world. I can't even count the number of times I've heard from business leaders in the world of diamonds the idea that diamond businesses are simply different. There almost seems to be a pride in the idea that the normal rules of bookkeeping and management accounting and corporate structuring somehow don't really apply in the world of diamonds, because diamonds are different. But let's be very clear. Even though the product is special and is unique for the diamond business, being different, being unique, is a luxury it can no longer afford, because being different is something that makes the diamond business more and more difficult for its existing financiers to deal with, and because being different is something that makes this an extremely difficult market for new banks to enter with any degree of confidence. That's why De Beers is so strongly committed to doing business only with diamond companies that can show us very clearly that in the transparency of their accounts and in their business structures, they are living by the best practices of corporations in every other commercial sector. So I want to turn away from the past now and away from the world of Muzala Bracha, and I want to look forward to the near future and to the new rough diamond supply contract De Beers will be entering into with its site holders in March 2015. To qualify for this contract, site holders are having to demonstrate very clearly to De Beers, through their financial statements, through their corporate structures, and through very clear transition plans, that they are building the financial credentials you'd expect to see in any strong and sustainable international business. I'd like to dwell for a moment now on what these credentials are. Firstly, De Beers is insisting that all the site holders should have an IFRS-compliant group structure. In other words, there must be a clear chain of control and a clear chain of revenues linking the corporate centre to all its global operations. All its global operations. This means there'll be full clarity over all the entities that comprise a site holders group and clarity over the corporate relationships between them. Secondly, we will require every year a consolidated statement of the group's annual financial performance. The consolidation is an important requirement. To produce full consolidated accounts, the group must, by definition, be held together by clear corporate relationships. Thirdly, we require the financial statements to be audited and to be audited by a strong and properly independent auditor that has been assessed and pre-approved by De Beers. De Beers is taking its due diligence on site holders' auditors very seriously this year, because the next of our requirements, and perhaps the most important of all, is that we will require the site holders' financial statements to have secured an unqualified opinion from its auditors. Now, let's be clear what that means and what an important step it is. As many of us know, it's been the convention for many years for diamond industry auditors to take management's opinion on the value of the stocks. On this basis, the auditors then give a qualified audit opinion. But for a diamond company, the stock value is often the biggest line item on the balance sheet, and if that's a matter of management opinion, the whole balance sheet becomes a matter of management opinion, and the auditor's opinion becomes worthless. And in the modern world, that just isn't good enough. By asking site holders for an unqualified audit opinion, effectively, De Beers is asking them all to ensure that they have consistent, transparent and complete processes to support their bookkeeping, their stock control, their invoicing and their financing, with sufficient checks and controls to give a strong and independent auditor the comfort to give an unqualified audit opinion. Finally, we want there to be real substance on the site holders' balance sheets in the form of a minimum value of genuine invested balance sheet equity in proportion to the total debts. Perhaps this is the most fundamental point of all. We want De Beers site holders all to have sufficient resources invested in their businesses to ensure they have the financial muscle to withstand the highs and the lows of the whole economic cycle. We want them to be financially robust long-term partners for De Beers and also for their bankers. So what we want to create in the eyes of the world is an instant association between the word site holder and a whole raft of positive associations. A group structure that's fully corporate and fully transparent, business ethics that are beyond reproach, management accounting that's worthy of a multi-$100 million business, tangible financial strength that's there visible on the group's consolidated balance sheet, reputable third parties overseeing full compliance, and when we wrap all of that together with the long-term offer of scale supply De Beers can provide, we think that will add up to one critical word: bankability. We can call that a new normal for sightholders. And if you stop for a moment and think how much of the global diamond business flows through the hands of the sightholders, this represents a step change not just for De Beers and its customers, but for the entire industry. Let's be very clear. No diamond business has a divine right to funding. But every diamond business that can show a normal structure, a normal business practices, a normal transparency has the same right to funding as any other business in any other sector. And that is the new normal for the diamond industry, to leave in the past the idea it can somehow play by different rules and to compete for funding on a level playing field with the rest of the corporate world. Now, for me, this is a tremendously exciting prospect. Over the last few weeks, I've been speaking face-to-face with financiers in New York, in Gaborone, in Tel Aviv, in Antwerp, and this week in Dubai. They're all hugely encouraged by the steps De Beers is taking. For the banks already involved in funding the industry, it opens up possibilities of offering new and more sophisticated funding vehicles to diamond businesses that have the right credentials. And for banks with no current exposure, these measures are clearing the way for them to consider gems and jewellery as a sector that's as straightforward to fund as any other business. Likewise for private banks, private equity investors, factoring companies and the bond markets, the message is getting out there that the diamond industry is opening for business as a safe home for their investment. So for individual diamond companies that are only just starting on the path towards corporatization and transparency, I think it's clear that at the end of that path lies the opportunity to access a whole new world of finance. Now, I started this talk by showing you one of my heroes, Bob Dylan, and I'd like to end it by showing you another, the cultural theorist Slavoj Žižek. Now, Žižek is interested in ideology, which to you and me simply means the way things are. And his theory is that for things to change, and he calls that revolution, but for things to change, reasonable people only need to make reasonable demands that within the current ideology are impossible. Now, I've talked to many CEOs and CFOs in the diamond industry this year who've told me that De Beers requirements for the diamond business to have a normal structure, and normal business practices, and normal transparency are impossible. So we should not underestimate the difficulties. We recognise that for some businesses, the changes they will now be implementing will require time and effort and commitment. But in the modern world, for the diamond industry to retain its right to be funded, it must abide by the same rules as every other business sector. It must be corporate, it must be accountable, and it must be transparent. There is no option. Without change, the liquidity pressure the industry is currently feeling will only grow more and more severe. But as the change takes hold, and it's a change that more and more sightholders are now completing, I'm very confident that progressive diamond businesses will find ever more funding opportunities opening up for them. To capitalise fully on these opportunities, the wider industry still has a lot of work to do. But if it's to secure access to the oxygen of funding, that's a deal to which forward-thinking diamond companies the world over are now saying, Mazalu Bracha. Ladies and gentlemen, thank you very much.
Howard, thank you. Thank you very much. I want to say a footnote about Howard. He's a very much not only visionary, but also a realist. He was talking with us about the IFRS, the stock management, and that the auditors have to be convinced, etc., etc. But he has said also something else to the sightholders. We realize it's not going to happen overnight. They have offered an option, correct me if I'm wrong, Howard, an option of a roadmap. They give some time, not much time, but give some time to get the act together. And Howard, this industry will get its act together. Don't worry. Like in every program, there are changes, and we are very, very much honored that the Honorable Secretary of Finance, Mr. Hashmukh Adia, sorry that I have to read his name, and the gentleman is already in the audience, and I think that the government deserves it, that we are also considered for government, sir. You are most welcome to deliver your address, and I think, what else can we have in a conference? Ministers from other country, the President of Russia, the Prime Minister of India, Secretary of Finance, Commerce, amazing, the golden age.
Thank you very much. Thank you. I apologize for the small change that I had to request for because I have to leave soon after. Mr. Vipul Shah, the President of GJEPC, the other office bearers, the distinguished panelists today, ladies and gentlemen. It's a matter of great pleasure for India that the World Diamond Conference is taking place in India. All of us know the importance of India in the diamond industry, in the diamond polishing and cutting industry. But what is a matter of pleasant coincidence is that the conference was started on a day when the entire world community, the United Nations, acknowledged the contribution of India also in the field of yoga. And yesterday, the June 21st will be celebrated as an International Day of Yoga. Incidentally, I hope all of you know what is the meaning of yoga. In Sanskrit, the definition of yoga is yujyate anena iti yogaha, which means something which joins together is yoga. So any conference of this kind, it is an opportunity for joining people together. So it was a pleasant coincidence that this conference and the announcement in United Nations came together. Well, ladies and gentlemen, first of all, I must tell you that I am here only to speak about the financing of this industry, not about any other thing. We are conscious of the fact in the government and among the bankers that this industry has a large contribution to make when it comes to generating employment in India. And that's what we need most now. As you are aware, we are really on a high growth path, while simultaneously with GDP growth rate, we are also looking at employment growth rate. And that's where the importance of this industry for us is there. But looking to the industry trend, it's a matter of concern for us that the export of gem and jewelry sector had a negative growth rate last year, 2013-14. Now we also understand that this is one industry which is highly dependent on high value imports of rough diamond, as also it requires a huge working capital for funding. But also what is the thing of most concern for us is that the credit by scheduled commercial banks to this industry in India, in all other sectors it has gone up by 10.19% in 1 year period, which is ending on September 2014. The credit growth in other sectors was 10.19%. While in case of the gem and jewelry sector, the corresponding increase was only 1.2%. Now that's a matter of concern for us. We are looking at the reasons for this. Of course, one of the reasons for this low credit growth is the growing percentage of gross non-performing asset in this industry, gross NPA as we call it. While the gross NPA of all the scheduled commercial banks in India for the period ending September 2014 is 4.56%, The gross NPO of gem and jewelry sector is 10.70% during the same period. This is, I am talking about the latest figure up to September 2014. In case of public sector banks, the result is more worrying. The NPA, gross NPA of public sector bank in this sector has risen from 5.3% in 2012-13 to 14.1% in 2013-14. So there has been a sudden shoot. Now let's analyze the reason for this. Why did this happen? Ladies and gentlemen, this is one industry where trust is the basic foundation of working between trade and financial institutions, as other speakers have also pointed out. This trusting relationship was going strong for the last 5 decades. Diamond being a unique product in terms of its characteristics and also in terms of its valuation, has strongly enjoyed the trustworthy relationship between the industry and bankers. However, last few years has witnessed some shake-up in this ingredient of trust that is core to any relationship. Recently, bank default done by certain fly-by-night operators in the industry has put a dent on this trustworthy relationship. Currently, the collective challenge is to uphold the missing trust to ensure the reduction of NPAs. Our Export Credit Guarantee Corporation too has taken certain required steps. Industry, while handling both exchange and commodity risk, needs to build that lost trust factor with the bankers. We understand that due to the recent events, the banks have made risk management programs a little tighter, but I hope this would soon taper off as soon as the trust is rebuilt between the industry and the bankers. There has been some movement, some kind of a defreezing done in the recent past by the Export Promotion Council. They have taken a number of initiatives. We had 2 annual banking summits apart from other initiatives to break the ice, and we are very hopeful and optimistic that this kind of a defreezing will take place very soon. It is extremely heartening to witness that this strong relationship between the bankers and the industry is now being rebuilt, it is being regained, and the perception of this sensitive industry is again now changing positively. Now to my banker friends who are here, I would like to say a few things. One is that we know that 70% of the cut and polished diamond in terms of value is being polished in India, but in terms of finance, only 40% of international finance is available, and that's where the bankers have got a golden opportunity. They can chip in, they can look at this figure as an opportunity to make some good business, and which is what they should do. So they should not be necessarily influenced by the stray incidents in the past. But if the companies have got processes in place, particularly the transparent mechanisms and audit mechanisms and good valuation practices, I think the bankers should look at this as a big opportunity and should go ahead and give credit to the gem and jewelry industry. Let me assure you at the end that on our part in the government, we are committed to support this industry as much as we can do with the help of our commercial banks and with the help of our public sector banks, and that commitment remains. I thank you, ladies and gentlemen, for giving me this opportunity.
Mr. Secretary,
Please don't go away.
Mr. Secretary, as an outsider, someone that came to India 2 days ago and is leaving tonight, or tomorrow night, actually tonight, I want to make a remark about your remarks. I know this industry. I heard what you said about non-performing assets. I heard what you said about trust. I can assure you, sir, the non-performing assets, the breach of trust, are by a few individuals.
We know it.
And you can help the industry. You can help us all by making sure that we get rid of those individuals. You know them, you are India, you have the power. You do that, the banking clients, the diamond people will be your best clients. You will be proud and happy. At the moment in Belgium, if I look at my friend Eric, half of the Belgium debt is Indian debt. It can also be done here. But sir, if you help us using all your power getting rid of it, you get the greatest applause of everybody here.
Thank you.
Thank you, sir.
So much for that extraordinary exposition of the support for the diamond industry from the government of India, and that message to the financiers who literally make the world go round, I think will be heard, and we should hopefully see a lot of liquidity in the financing of the diamond industry. So thank you so much for that. I'd now like to call on Anup Mehta and Vipul Shah to show their appreciation to Mr. Adir. And thank you so much for sparing the time. I know you've got a very busy schedule, particularly with what's been going on in geopolitical terms with Mr. Putin's visit. Thank you.
It's now my pleasure to... Sir, thank you very much. Okay. It's now a great pleasure for me to invite Pranay Navakar, who is a close friend, associate, terrific. But Pranay is presenting a tool that will help the bankers and it will help the industry to meet better the compliance requirements of your clients. And Pranay, I'm very excited about your message. Let's give him a warm hand.
Thank you, Chaim. We heard earlier today both Howard and Eric talk about bankability and transparency, but I think Eric probably did not have something like the wrong presentation. It's the wrong presentation.
Give me a second. This one, right?
But Eric probably did not have something like this in mind. When you want a transparent statement, you don't end up with a hole in the balance sheet. So that's probably something which Eric and Howard will probably sort out over the remaining part of the conference in the discussion. But coming to a more important point which I would be talking about, it is really, a lot of them have talked about we want to bring in transparency. The question is, what do we do or how do we bring in that transparency? And this project, which is being launched by or will be launched by the Gem and Jewelry Council, and of course with all the bourses and the WFDB, is to bring in that transparency into our industry. The question really is, how do you bring in transparency while at the same time helping reduce the transaction costs in the industry? And if you put that question in that fashion, we'll come to that conclusion by the end of this discussion. So going forward, the industry has been designated by the FATF calls the diamond and the gem and jewelry industry a designated non-financial business or profession. What it means in simple terms is you need to do due diligence in all your transactions. You do that today. It's covered through all different guidelines by different countries, which have set their own standards, and it applies to all members of the industry. So it applies to the producers, the dealers, the manufacturers, the wholesalers, and the retailers. The recent report, the FATF Egmont report, we've heard a lot about that. That is also highlighted that it's not just the cash portion, but that the non-cash transactions are also a potential risk in the industry. So how do you really try and sort this issue? Now, if you really look at the diagram, the industry is a spaghetti chart. Chaim has made the spaghetti chart famous, which is basically everyone deals with everyone. Okay, you have a lot of dealers. There are a constant stream of transactions, a huge number of relations which you have in the market, and you need to do the due diligence on all of them. So taking this forward, as an industry, we're subject to various audits, various regulations. So you have your BPP, your RJC. You have your customer audit, all the large customers, credit insurance, be it AML regulations, be it FATF guidelines, or any future protocol. Now, the one thing which is part of any of this is the KYC, the know your customer, or in reverse, the know your supplier. You need to know both ways. So what you sell, you need to know what that person's intention is, and you need to do your due diligence on him. And the other way around, when you buy, you need to do your due diligence in terms of, are you buying something which is good and correct. But this KYC standards, there isn't really an industry-wide standard. No one says that this is what is required, these are the documents required. Every company has their own standards. They have done it, they've set it. Every country has their own standards. And I don't know, Howard, you can close your ears, but whenever there is an audit, I think most of the people undergoing that audit will have spent a sizable amount of senior management time trying to ensure that their KYC documents are up to date. So you'll have your salespersons calling your customers, wherever there are gaps, identifying them, filling them out. It is a time-consuming process, and it is something which requires a lot of management time. So can we make, or how can we look at this process of the KYC and use the digital medium to make it much more transparent and also help the industry in the same breath? So that's how we came about the idea of the My KYC Bank platform. What is, in simple words, what is the My KYC Bank platform? It's a platform, it's an online platform. Companies can update their own KYC information. So you update your own KYC information. You will need to do that. If I want to become a member on the system, I can't do that. I will have to be a member of an authorized or an approved associate entity. So that would include all the industry bodies, the WFDB bodies, the other bodies like the GJEPC, the AWDC, and any other bodies which the group approves of. So in that way, what this body will do is, it will verify the documents of its own members. So if you're a GJEPC member, you will submit your documents to GJEPC, who will check it, okay it. The rest of the information is checked by the system. The same thing will happen for your customer or supplier in Antwerp, where that information will be verified by the AWDC, let's say, and that will be updated on the system. Once that is done, so what this does is it brings in a second layer of check. So it's not just you, another layer of check is coming in. And the information collection is also standardized. There are a very clear set of guidelines as to what information will be collected, what is required, and you will make it best of class. So you will ensure that that information is sufficient for a large section of jurisdictions. Once that is done, you will get an identification number. So every company in the industry will effectively get an identification number. In simple words, it's like an Aadhaar card or a social security number. Every company will get that tag, then it becomes very easy to identify the problem. Information can then be shared. So once I have my information, then it's like a LinkedIn or any other online platform, except that this is a platform for companies. It's not for individuals, it is for companies, and it is for KYC information. So you can share your connection, and your connection will be able to print out your KYC information at any point of time. What are the advantages? The single point. I don't have to do it 10 times. Every time you have a new customer or a new connection, you also have to give your own information. Your company information is sent across. It happens, you do it once, you do it right once, and it can be shared automatically with all your connections. You have control, so it's not that the world can see this. Only your connections will be able to see it. At a later date, what can be done is banks, who are your customers' banks, may be able to see it, because for them, for the banks, that's an important need, because you're taking an exposure on ultimately the customer. And of course, it'll be a nominal fee. Just a quick word on the concept which is used. We're using the concept of a circle of trust. This is very similar to what you do if you get a digital signature. So there are certain authorized bodies. You trust them. So that would include your GJEPC, your AWDC, your WFDB members, any other entity which has got into the fold. Once those because you trust that entity, and that entity in turn trusts its members, automatically that chain of trust is built through. What will be the responsibility of the authorized or the approved entity? One is there will be a minimum code of ethics. So it would mean that a lot of dispute resolution within the industry can also function more smoothly. And they will also verify the information, as mentioned before, of their own members. Additionally, these approved associated body entities, a working committee or a working group will be formed. This group, the main function of this group is to accept new entities. So how do I decide that this board in this country is someone I trust and I will accept? Second, if new information is required, so if you want additional disclosures after a year, who is the person who does that? It is the industry bodies. And third, you can set norms and code of ethics. So what are the kind of basic code of ethics which will be followed by the other bodies? So that's kind of the role of the working group. That's essentially the entity or the agency which is running or is controlling the main governance aspects of this entity. Very quick process. How will it work? You have your members. So the members will update their own details on the platform. They will submit their documentation or documents which are necessary to their industry bodies, who will verify the documents and give it back to the platform. The platform will additionally check that the information and the documents match and it's correct. This platform, it will be launched as a not-for-profit subsidiary of the Gem and Jewelry Council, and then additionally the working committee will be formed with all the main bodies in the world. This is the body which will set the governance policies. That's the body which will control this. What are the advantages? At a very, very pure company level, because for any initiative to succeed, the members themselves should see the advantage of this. At a for every member, at a pure transactional level, purely transactional, you get accurate and verified KYC information in real time. So if the update is done by your member, immediately you can see that a particular detail has changed. Reduced compliance efforts, because automatically the KYC portion is taken care of. Standardized best-in-class KYC norms across the industry. And of course, from you doing the KYC for yourself, with your customers or with your suppliers, it becomes a single point where you need to update the data. that's automatically propagated to everyone. You also have full control over, who are the customers and who are your suppliers, who can see your information. So it's not publicly available. Only when you give specific access, you will be able to see that. But now let's come to the more interesting part for the banks, for the regulators. One is, of course, you will be able to get a unique identification. I mentioned this. Whenever we talk of the industry, the laws are different across countries. In many countries, it is not essential that you need a separate or special registration to be part of, to be recognized as part of the industry. And by doing this, you will be able to kind of, the first step in trying to solve an issue or a concern is identifying what the issue or concern is, or identifying the scope of that. And this will, in a way, help us identify this is the scope of the industry. This is whom we call the industry. Second, you will have much more transparency over which are the transacting parties. And thirdly, the authorized bodies themselves, they will have, or they will be able to take much more proactive steps in regulating the industry. And I think Eric also asked for that the industry bodies should be much more proactive in some of those things. This will give some amount of teeth to the industry bodies. Gradually, of course, this is kind of, a few years down the line, you can think of extending this. So you can look at, do you want to bring it into KPE as a tracking system to avoid duplication? Again, this is subject to discussion. This is not, of course, fixed. If the industry finds the need for it, this can be extended. The shipment receipt confirmation. So banks have been asking for that in Antwerp more so because the shipments are direct. Now that entire shipment receipt confirmation process can be automated, so it becomes a single point where you can see that information. For banks, from a risk management perspective, they can get a much more holistic view of what the exposures are like. So that's the other bit where it can be extended to. What are the timelines looking like? So the company formation process is in place. We should be up by January, and by about April, by January we'll also form the working group, so we can actually start the formal discussions and have all the requirements on board. We will look to do a launch by about April, May, where you kind of push the first system. You'll do the pilot in India, and you will later extend that pilot into the global companies or global bourses by, say, September onwards. And of course, April onwards, you can look at other areas as well. Well, I guess, everyone wants transparency, but the whole idea is that by doing that, you don't end up with the company disappearing itself. Thank you.
Thank you, Pranay. Of course, this is an initiative of Pranay together with the German Dual Export Promotion Council, which ought to be stressed. And there is a footnote. There's always a footnote with me. The KYC, Know Your Client, and it is an extremely important tool, but it had a purpose. And the FATF that was mentioned, and I started out with this, and I had the pleasure on behalf of the World Federation and on behalf of Mr. Ernie Blom, the president, to be liaison with the authors of that money laundering and terrorist financing report. The purpose of the KYC is not just that you know who your client or your supplier is, but you have to know that the sources of his money are clean. It's not enough that you know this guy from Korea that you sold money to, or Singapore, or whatever, he is sending you the money. You must know that that money is clean. That is not easy. We are lucky that we have the banks, because the money goes through the banks, and the banks have very severe requirements on knowing where the money comes from. So if you know exactly the company information, you still, if you make sure you do it through the banks, that heavy responsibility, Eric, to know that the money is clean remains yours. Not an easy thing. But thank you, Pranay, for a tremendous initiative. We are now moving to the panel. And you're always looking at me saying, Chaim, go. And
No, we have Kishore now.
yes, but he's part of the panel. Kishore, it's all yours now. So you are now
And Mr. N.K. Chari
from the State Bank of India. Yeah. The Kishore, good to see you. I don't know who's bigger today, Standard or ABN AMRO, or you're kind of equal?
I'm 186, and Kishore, what tall are you?
You're about... And I'm 110 kilo.
Yes, thank you.
I was. I got some more last night. Kishore, please make some initial comments in the State Bank of India, and then we'll have some discussions.
Well, good morning, dignitaries and guests. I was not expecting to make any initial comments, but I'll say two or three things. Standard Chartered Bank is very proud to be a major global lender to this industry. It is a very exciting industry. And I think what makes it special is the people in it. There are several aspects that have been discussed about the people who are in the industry. It's a very international group in the truest sense of the term. The emphasis on integrity has been mentioned and continues to be very important. And I think also something that's very powerful in this industry is the enormous creativity. And if you just see, for example, the great contributions made by people of Indian origin, whether they be living in India or in Antwerp or in Israel or in South Africa and in so many other important geographies. I certainly shouldn't leave out the United States, New York. It's the creativity and the entrepreneurial drive. I think a couple of the senior government officials talked about the need for this industry to become more creative. I certainly think that could be applied to any industry, but I think it also somewhat overlooks the enormous creativity that the Indian business community, and I should really say people of Indian origin, because Antwerp is a key portion of that creativity. There's also been a lot of talk about transparency. I think what's really important when we talk about transparency is not simply that you see through, but that the transactions be bona fide and be real transactions. If you see through transactions, or if you think you have visibility on financing what you think are third-party transactions, because that's what the clients represent to you, and you later on find out that in fact they are not third-party transactions, that causes an enormous amount of grief. And grief, I think, is the right term. Bankers are in the risk-taking business. They sit down with their clients and they review projections, and every now and then things don't go quite the way they should do. Bankers can accept that. That's part of the risk-taking business. What is not acceptable is when representations are made and it appears that you have transparency into transactions and businesses, and then the banker later on finds out that that in fact has not taken place and those weren't bona fide trade transactions. And that then creates a negative emotional reaction that is much harder to overcome than that of a normal banker who's financing an industry and the company's plans don't quite go the way they have, and where it is more of an intellectual and mechanical exercise. The one other comment I'd like to make, if I may, on the banking side, is that the Indian public sector banks and the Indian banks have played a very important role in financing this industry, but their financing has been largely focused in India. There has been some financing in Antwerp, but a lesser amount in other locations. In fact, about 20 years or so ago, if someone were to ask me what I would have seen as the biggest competitive threats to financing the industry, excuse me, I would have said it's the Indian banks and the Israeli banks, because both banks have huge, enormous advantages in having a natural and organic understanding and knowledge in India and in Israel at that time of their respective markets, that they had physical presences internationally, but they hadn't really leveraged the knowledge that they had in their home base to get additional business for themselves. And there's a double advantage in it. There's the commercial advantage of generating more profits for the bank, but equally importantly, and perhaps more importantly, it would provide the banks with a better risk framework in having a better understanding of the various trade flows in global networks when the banks themselves would have an actual physical presence there. So I would encourage also, if I may, for the Indian banks who have done an excellent job in financing the industry in this country to leverage that excellence in overseas markets.
Kishore, you are always an extraordinary personality. You call a spade, and that is really appreciated. You talked about grief, and your candidness is really admired. You mentioned non-tolerance of transactions which are not genuine transactions. You mentioned the problem of third parties not really being third parties. And that leads me to a question. When you find out, what actually do you do? Like I asked the Commerce Secretary, what do you do to get rid of those clients? If you find out that there is this kind of thing going on like this, you know what I'm referring to, or that third party is not third party, you tell the client you have 60 days to get out of here?
Well, I think one thing that all banks do, not just diamond banks, is we do not handle that situation well. Common sense would dictate that if you have a problem with one or two or a few clients, that you need your good clients now even more. But that's common sense. What happens in real life is just the reverse. You tighten your belt, and you tighten the belt across all clients, and in particular the good clients, and the same yardstick is applied across the board. That's nothing to do with the diamond industry. That's just a generic global banking issue. It happens by banks in all industries. And I'm not sure if there's any good answer to it. But certainly if you look now more specifically at the diamond industry, there have been some unusual events, and I'm being a little bit diplomatic, but perhaps I should say there have been some players, and I think the Commerce Secretary acknowledged that there are a few players. It certainly is by no means across the industry, but it creates a stigma and a taint across the whole industry within the managements of those banks who finance it and who are not intimately involved on a day-to-day basis and do not see the great level of integrity and honesty and entrepreneurship and brilliance that exists across the whole industry.
Thanks, really thank you, because the industry is being penalized for really the misdeeds of a few. You were shaking your head, Eric, but may I ask our friend from the State Bank of India first, and then I see you shaking, and I don't want you to be shaking. Go ahead, sir.
Good morning to you all. I think the thing which has come out very well in the talks which have taken place so far is that this industry is based on trust, and it will continue to be based on trust. I will carry it a little forward from what Howard Davis stated about Mazal Ubraka. I presume I am pronouncing it right.
Like an Israeli.
So, I think the Mazal Ubraka continues with only one dimension, and which is the change which is taking place over a period of time, is that when you shake hands, you want to feel the continuous warmth of that shake. So you would like that hand to be as warm as it is always, indicating the trust which continues. And when you look into the eyes, as Davis pointed out, you are looking into the eyes to see that that eyes is not hiding something, it is making it pretty transparent. That's the Mazal Ubraka which applies in today's world, with so many regulatory constraints which have come in. I agree with him entirely that the regulatory changes have to be accepted, which have to be absorbed by the industry also, and it is happening. Our relationship with the diamond industry in India and in Antwerp has been exceedingly good. I can say for sure that the defaults which have taken place in the gem and jewellery industry has not been in the diamond industry per se. It has been in areas which are other than diamonds. So to that extent, the diamond industry is really a respected industry even today in the banking sector. Some of the problems which the diamond industry are facing, which will come as part of the discussions which will happen, are beyond the banks. If there are some regulatory requirements, if there are some requirements from the outside agencies which are important for the financing of an industry, they come into being, we have to respect that. So the major concern, as I see, for the diamond industry in India is the insurance of their the industry which is taking place through the ECGC, as we call it. That has undergone changes in the last few years, and the industry has been telling me, last year also I was there in Bombay when the meeting took place of some similar conference, and I had mentioned that it is important for the industry that they should interact with the ECGC in a very big way and make them understand that it is necessary for them to look at diamond as a segregated section of the gem and jewellery industry, look at the track record of this gem and jewellery industry, and see that the same norms which they are wanting to make applicable for the entire industry on the basis of their credit experience, insurance experience, doesn't affect this industry's margins. So I think this is something which is taking place at the industry level. They are trying their best, and we as bankers will definitely support the industry in trying to make data available to them as to where the diamond industry stands and where the risk seems to lie when you talk about gem and jewellery industry.
Thank you for that. Now we have to make sure that Eric gets out of his shaking.
Not so much shaking, but more concern, because let's not talk ourselves into a depression. I mean, this is a great business, and we've had these 2 days to prove that as well. And I will keep it short, by the way. But I think we're not penalizing, or the industry is not penalized. Yes, there are challenges, but compared to any other business, there are also challenges. So really, it's a call not to talk yourself into a depression, and the banks are there to support in a different way. There are new banks coming in, and it is also changing. And we had a last week a very interesting meeting together with State Bank, together with State Bank India and ADB and ABN AMRO then in Antwerp, and it was for the Young Diamantaires Club. It's a new club, was sponsored also by the Boers in Antwerp, and these are the Diamantaires below 40. And I think there you see the new generation as well coming in, and they speak the same language. So I think that is a great thing to do. And one thing, and perhaps you remember that as well, we talked about KYC. This is also something like KYT. And that's actually Pierre de Bosser from ADB who brought it up, know your transaction. And I think that's also where Kishore was referring to. So I think that's also something to remember, KYT. Thank you.
Howard, Eric, I think there was this author about those books about that lawyer Rumpole, and he was always talking, and bailiff, he was all talking about, you know the better, you're British, about she who has to be obeyed, and that was his wife or whatever, and she who has to be, and we also have someone that sees has to be obeyed, and that is my friend there. So we have to, I would like to just in one line summarize my understanding. I think that we have banks that support us. I think we have banks that trust us. I think that we all know what the problems are. And I think that we are all committed to get rid of those problems. And I think that is feasible. So at the end of the day, Howard, you can go home and say to Philip and your colleagues, the banks are with us. We can continue to sell Rolf. But that doesn't mean you have to increase the price immediately. Ladies and gentlemen, this panel was great, and thank you for giving us your insights, and back to she who has to be obeyed.
So great status to occupy. Thank you so much to all the panel members, and I hope that these discussions will continue outside the World Diamond Conference. I think we've had a very productive session on banking and financing, and I think some of the principles that have been established are very important. But I also think that some of the myths that exist about banking and financing have been shattered. So that's been very useful, and I hope the dialogue continues between the industry and the very important financiers of the trade. Thank you very much to all concerned. I would like to acknowledge the presence of Maxime Shkadov, the president of the IDMA. Maxime, perhaps you could stand up. Thank you. And before our panelists leave the podium, I'd like to ask Maxime and Janesh Dolakia to present a token of our appreciation to Eric Jens. Thank you. Maxime, please. Maybe you could come this side for a photograph. Yes, in front. Thank you.
You have to be in the middle there. You're the banker. That's where the money is.
Thank you. I'd like to call on Milesh and Stefan Fischler to present our appreciation token to Howard Davis. Milesh? Thank you. Please. Thank you. Thank you very much. And to present to Mr. Chari, Pankaj Parak and Bharat Bai, please. Ajesh Mehta to present to Kishore Lal. And to Pranay Navakar, Damesh Shah, please. Thank you. Thank you.
I want to join you, okay? And now in the middle. In the middle. Now, where's the book? That's it. Thank you.
Thank you so much for your attention. And because of the big events yesterday, you'll recall that we had a very important selection of speakers to talk about the retail sector and meeting this burgeoning consumer demand in the big economies like India, like China, which are becoming increasingly important. And we are also looking forward to the perspective from the chairman of the World Diamond Mark, Alex Popov. And I think all of you will have seen on the posters behind me the slogan, "It's the rock on which the future will be built, and let's shape it together." And that perspective, I think, is very important. Understanding that the initiatives come from industry are much stronger than those that come from outside. And the World Diamond Mark is really trying to progress things within the industry with education, accreditation, and generic promotion. Unity within the industry. And for more on that, Alex Popov, one of the founders of the World Diamond Mark and the chairman of WDM, is going to speak to us in more detail. Thank you, Alex.
It requires some technical work. Can somebody help me with the technical work?
It's already saved.
No, it's not.
It's already saved.
No. Open the disk. You saved only one, what I need.
If you can operate from here itself.
Yeah.
Which one?
Just a second. Here we go. This is saved.
Yeah.
This one.
It's already there on the desk.
It's already there. I need the two movies. This one and this one.
So do you want to just operate from this folder?
Yeah, it's all right.
Yeah?
Yeah. There's a movie there that I need to run the movie. That's no break. Just a second. Can we go back? Wait. Okay. How do you put the movie on?
Do you want to embed it here?
This is embedded movie. This one, how do we? Maybe just less.
I think since we're having some technical issues...
I think it would be a good idea to have the coffee break, and we will solve the technical issues meanwhile.
Thank you.
So it works, yeah? So what should we do?